So here we are again with Nick Denali Guide, expertise in gold mining, silver mining, stocks. He's got a word for us today. Hi, Nick.
Hey, how are you doing today?
Awesome.
That's good.
Go ahead.
This is Cowgirl. This is my editor. She makes things happen.
Go.
Okay. Well, there you go, Cowgirl. Let's talk about smart investing in gold. Let me get this off of here. I gotta take my thinking cap off. And why standing your ground can make all the difference in what happens to you. You've heard the saying, who you know is important, but who knows what is more important. When it comes to these markets, silver and gold, I make it a point to follow people who know what. That is, what's what. Today I want to share some lessons from the trenches. Oh, smile, that's right. That's what I'm supposed to do. Okay, why investing in gold miners can be worth the ride. Having a plan beats panic every time. And it's about standing your ground. Fear not, when a smackdown comes around, stand your ground, because the price always comes back. Gold miners, they're small bets, but they have big potential. Why would you take the risk in investing in a gold miner rather than buying metal? There are two reasons that I know of. First of all, you have small bets. They have great potential. As I noted in my newsletter, shares in the miners often start as low as 20 cents and sometimes go to $20. That means for $100 plus a commission, you can get in on the action. Now, when these small companies hit new deposits or attract buyout interest, these really small positions really move. Second of all, leverage and excitement. Physical gold is a store of value. Mining stocks, though, are not. They carry leverage, so they can go up and down fast. When the right news hits, the stocks jump far faster than gold could itself. Now, let's look at this from another angle. Physical silver and gold are insurance. They are not about speculating. They allow you to protect yours, whatever you hold. Let's compare holding the metal, say coins and bars. Is insurance not leverage? It holds your purchasing power. Nobody can swindle it away from you as long as you can put your hands on it. I buy metal when I want to protect the cash, not to speculate. And because the gold-silver ratio right now is really out of kilter, it's 100 to 1. Right now, you might find it far easier to accumulate metal silver than metal gold. But when it comes to mining stocks, the ratio does not apply strictly or loosely. There's a wide variety of plays in both metals. Now, early mornings. Keep your own canaries. You've heard of sentinel species? This is my sentinel species.
Now, hold on. Straighten it.
Yeah, this is my sentinel species. And this kind of indicators that I like to give me an indication and a heads up when things are changing. You have your own. It's like having a good watchdog. When something shifts, somebody's in your parking lot who doesn't belong there, they're going to let you know. Last week, my canaries were chirping really loud, like a bunch of huskies ready for a good run. Barking. I picked 190 stocks over a 2-week period to be my bank. Okay. That's really unusual. Maybe I get 20. Maybe I get 40. This time, as usual, only 10% made the cut, but it's a relatively stringent cut. The spread was interesting. Explorers, developers, producers, gold, copper, zinc, silver. Now, that was a broad and healthy mix. What was unusual about it is explorers seldom, if ever, hit the list because they don't have anything to show for it. So, let's take a history lesson. What happens when a whale tries to bite you? The tail of the whale. Back in 2015, when the U.S. Treasury lost its AAA plus rating, some unknown player had a hissy, and they had the ability to dump 3 years of Newmont Mining, the biggest in the industry, production on the market. Well, that's not unusual. They got to sell it in one day. That was really ridiculous. Gold crashed in the mid 700s to the mid 300s. It took 3 years to recover, but when it did, it went to 1900. Meanwhile, the biggest gold miner ETF, GDX, dropped from 26 to $12.64. But once it broke free, it ran back over 26 and ran all the way to 46, tracking gold's rally from 358 to 1900. The lesson? Fear not. Those people who stood their ground prospered. Those who panicked and ran, they're done. They lost out. So this is my final advice from experience. Fear not. If you run, you're done. In volatile markets like gold and silver miners, patience and planning pay off. Don't chase every headline. Don't get shaken out when things dip. Fear not. Keep your canaries close. Follow the signals and not the white noise. Keep your squelch turned up. And if you'd like more insights, you can subscribe to the DGS letter, or you can subscribe to the blog, and you can subscribe to this channel. Whatever it is, thank you so much for coming in. I have a great time doing these videos, and I really appreciate you. Have a great day.